Rule number 1 of investing is, wait for it, don't lose money. This is the way. Okay, the video's done. Thanks for coming. See ya. Sounds pretty simple though, right? All you have to do is buy today's hottest meme stock, then you're good to go. This is not the way and a lot more risky than you think. The bad news is that no matter how good of a trader or investor you are, at some point you're going to lose money, at least on paper that is. The good news is that as long as you start slow, build some basic stock market knowledge, and learn the fundamentals of investing, you should end up with some pretty healthy profits over the long run. As a beginner investor, you should keep it really simple to start out with while you get the hang of investing in general. Now, even though it's really tempting to treat the stock market like a casino and YOLO all of your money on some rando penny stock, that's not how people become really rich through the stock market. If you want to do that one day, then more power to you. But for now, let's cover some of the basics that a beginner needs to know when it comes to investing from someone who has been investing for years. And that someone, it's me, your Uncle Jarrad. We're going to cover things like living off your investments, how much you need to get started, how to protect your investments, the best way to invest, and a few more things to get you started. Real quick though, please make sure to Hulk smash that thumbs up button, because this girl that I have a crush on said that if I get enough likes on this video, then she'll go out with me. The fate of my future love life is now in your hands. Here we go. This video is a follow-up to the one that I recently did on how the stock market actually works. So go check that one out after this, which will probably answer some additional questions that you have. I'll have that linked up down in the description of this video. One thing I want to beat into your head right off the rip is investing is for growing your money over the long term. Think 5+ years. And income from your job that you have, from the job that you have today, is to pay for everyday expenses in the short term. Try not to get those two things mixed up, because if you start trading stocks with the intent of making some quick cash to pay your bills today, you're going to start making some very risky investing decisions, which are going to reduce your chances of making money and increase your chances of getting burned so bad that you stop investing completely. I know it's easy to see your investment account go up by $100, $200, or $300 and think to yourself, wow, that's enough to pay for some of my food this month or cover some of my rent or mortgage. But if you play your cards right and keep that money invested, then that money in there right now will be able to pay for multiple years of expenses later down the line, because it should continue to grow over time. When you constantly pull money from your investment account when you don't actually need it, you are continuing to slow down the growth of your investments. It's like expecting a tree to grow, yet on the other hand, continuing to come back year after year and chopping off the top of that tree. Of course, the tree's not going to grow because you keep showing up to freaking cut it down. What do you think's going to happen? You don't need much money to get started investing. With a lot of these new brokerages like M1 Finance, Robinhood, and Cash App Investing offering fractional shares, starting with as little as $1 is easier than ever. I know $1 doesn't seem like a lot, and that small of an amount isn't going to give you insane returns in terms of dollars, but you've got to start somewhere. As long as you're consistently putting money into the account on a regular basis, then building a 6 or 7 figure portfolio is going to be a lot easier than you think. Consistency is the key. The best way that I've found to learn a lot faster is by actually getting your hands dirty. So don't hesitate to start investing, even if it's with just a little bit of money, just to learn the process. I can teach you how to throw a baseball, and you can watch me throw a baseball, but until you actually throw that baseball, you have no idea what you're doing. What the heck was that analogy? But before you put a ton of money into your investment account, having a little pile of cash set aside in an online savings account for non-investing purposes is going to give you a little bit more freedom and increase your overall investment returns. Yes, I'm saying that you having money sitting in a savings account earning a trashy 0.5% interest rate is going to increase your overall investment returns. Let me explain. Sometimes this is referred to as an emergency fund, but honestly, you can call it whatever the heck you want. I don't care. Now, the only reason it exists is to help you pay for surprise expenses when they pop up that you weren't planning for. The reason this is going to benefit you when investing is because when a random emergency happens, like your car breaking down, Miley Cyrus concert tickets going on sale, your phone breaks, or whatever, you can pay for those things with your emergency funds as opposed to selling off your investments to cover those costs. And we all know you gotta get those Miley Cyrus tickets. You see, when you first start investing as a beginner, emotions are going to be at an all-time high. When investments are up, you're gonna feel like you're on top of the world. But when they're down, you're going to question all of the decisions that you made in the past. And the last thing that you need to happen if your investments are down is for one of those emergencies to pop up and you start ripping money out of your investment account. Next thing you know, you're selling off your investments when they're down to pay for that emergency because you didn't have a little money set aside beforehand. Being forced to sell investments when they're down is going to end up eating away at your overall returns. Emergency funds are the most annoying thing in the world, trust me, because I hate having cash just sitting around. But think of an emergency fund like a little insurance policy for your investments. But if it's going to prevent me from interrupting the growth of my investments through selling some of my stock, then I'm okay with that. I'm not saying to have a full 3 to 12 month emergency fund in place before you start investing, because I think that most people should get started with investing as early as possible, but at least have a little something set aside to begin with. Now, as your investment account gets larger, you should absolutely be growing your emergency fund at a faster rate until you reach a level that you're comfortable with. Now, back when I only had a few $100s invested, I was okay with having a few $1,000 emergency fund at that point in time. But now it's just not worth risking a smaller emergency fund given how large my investments have grown to. I get two questions quite a bit. The first one is,
Jarrad, how safe is investing in the stock market? I feel like they're just gonna take my money.
Or,
Jarrad, how much money can I lose?
the stock market, and especially the US stock market, is pretty reputable and safe at this point, so there's really nothing to worry about when it comes to safety. As long as you use one of the more well-known brokerages out there like Vanguard, Fidelity, M1 Finance, maybe not so much Robinhood anymore, then you're good to go. But what you invest in and how you invest in that stock will determine how safe your money is. Any sort of investment, no matter what it is, comes with a level of risk. You'll never be able to get away from that, whether it's with stocks, real estate, investing in a startup, starting a business, buying a franchise, a relationship, or whatever. If you want to grow your money at a rate better than if you just kept your money in a savings account, then getting comfortable with a little bit of risk is going to be important. I can tell you now that just putting money into a savings account as opposed to investing it will not build you wealth. You'll actually lose money due to inflation, since the interest rates on savings accounts are absolutely horrible. I think that when someone asks how safe is investing, what they really mean is how risky is investing. When you invest for the long term, you'll eventually lose money, at least on paper that is. Money isn't actually lost until you completely give up on and sell an investment. As your investable assets grow, there's going to be even bigger swings with your money increasing and decreasing on paper. There were months in 2020 where my overall portfolio was down tens of thousands of dollars because of the amount that I had invested in the stock market. But I didn't actually lose that money because I didn't panic sell my investments. Those were what we call paper losses, not realized losses. Don't treat the stocks that you invest in like your past relationships. You need to invest in those things. You need to hug them. You need to love them. You need to hold on to them. You need to give them more money. What you invest your money into will determine the level of risk involved. The more risky it is, the more money that you could potentially make, but also the more money that you could potentially lose as well. If you invest all of your money into a couple of stocks, then naturally that's very risky. If all of those companies happen to be in the same industry, then that makes it even riskier. A portfolio that only holds Ford, GM, Honda, and Toyota stock would be absolutely insane. When the car industry takes a big hit for whatever reason, then you're pretty much screwed. You've put too many eggs in one basket. When you pick individual stocks, think about looking for companies within different industries to spread your risk out just a little bit more. Don't be afraid to invest in multiple stocks within the same industry, of course, but make sure that the majority of your money isn't concentrated into the same one or two industries. Safer investing is all about understanding your personal level of risk and building out a portfolio of investments to match that in a way so that when they're down in value, you don't panic sell and lose all of your money. There's really two different ways to invest. Now, pick one to begin with so that you can reduce as much confusion as possible. But for beginners, I would recommend one over the other at first, and I'll explain explain why. The two types are active and passive investing. There's nothing wrong with either one, but it's more of a matter of personal preference than anything. You can technically do both if that works for you, and I'll explain how that's possible in just a minute. With active investing, you're doing a lot of the work to go out there and find stocks that you want to add to your portfolio on a regular basis. You're actively pulling up a stock to analyze the company at a deeper level, to understand if you want to purchase it, the price you want to try to purchase that stock at, and what your exit strategy is going to be. Not always, but sometimes this type of investor is also actively selling stocks on a more frequent basis to either cut their losses, take some of the profits that they've earned from the stocks that have increased in price, or try to get in on stocks early that have a lot of upside. An active investor is doing a lot more, which is why they're called, wait for it, active investors. If you're someone who's interested in digging into the fundamentals and enjoys continuing to monitor stocks, then this style of investing is for someone like you. There's a lot that goes into this investing style, so I wouldn't suggest thinking about going this route for a beginner just yet. If you do it properly, then active investing is more time intensive, so you're going to need to be able to set aside a few hours every week to dig into the investing data on a regular basis. If that doesn't sound appealing to you as a beginner investor, or thinking about having to do that is making your head spin, then that's perfectly fine. Passive investing is going to be a better way to start for 99% of people because it's a lot easier to do, understand, and a little more straightforward. With this type of investing, you're not actively trying to buy and sell stocks on a day-to-day or week-to-week basis. A passive investor will sometimes do this, but more often than not, they're going to kind of just buy something like an index fund or its ETF equivalent and hold on to it for a long period of time. Since an index fund will expose you to hundreds, sometimes thousands of stocks, your risk is automatically spread out among enough companies to where it's not something that needs to be monitored on a regular basis. You kind of just buy the index fund and forget about it. I'll have my video on everything that you need to know about index fund investing down in the description for you to check out after this video. Also, keep in mind that you don't have to pick one way of investing and stick with it forever. You can dabble in both at the same time or even switch from one to the other as time goes on. An example of someone who utilizes both investing styles would be a person who invests passively in his or her retirement accounts, but is an active investor within their taxable investment accounts. I have friends who dabble in both and it works out perfectly for them, so I can't knock anyone who wants to do both. But at first, I would suggest sticking with the passive method until you get a little more hands-on experience with how the stock market works and a good understanding of how you personally react to certain things that happen when your money is invested. After that, if you want to start playing around with picking individual stocks, then allocate a small amount, like 10% of your total money invested, towards that sort of thing. If you find that you are starting to really enjoy it, then increase that amount. As much as I love everything about investing in the stock market, I'm personally more of a passive investor. About 90% of my money in the stock market is in an index fund ETF like VTI or VOO, and the remaining 10% are in other things like individual stocks and speculative investments. As a beginner, you're going to want to start investing your money into a tax-advantaged account like a Roth IRA before putting money into a taxable account. This might not seem like a big deal, but it is when it comes to saving money on taxes. Not all investment accounts are created equal, and not all brokerages offer the same type of accounts. For example, Robinhood and Cash App Investing only offer taxable investment accounts at this point in time, but brokerages like M1 Finance, Vanguard, and Fidelity offer a Roth IRA. I have a whole video breaking down what a Roth IRA is and how to invest in one that I'll link up down in the description. The difference between a Roth IRA and a taxable investment account is that you'll never pay taxes on the money that you withdraw from a Roth IRA, but you will pay capital gains tax on money that you withdraw from a taxable investment account. So if years down the road you withdraw $1 million from a Roth IRA, then you'll get to keep that full amount and not pay taxes on any of that money. But if you withdrew that same $1 million from a taxable investment account, then you'd have something like a 15% capital gains tax, which would come out to a tax bill of about $150,000. This would only leave you with $850,000 left over. That's a $150,000 savings just because you invested money into your Roth IRA before investing into a taxable investment account. I'm not saying don't invest your money into a taxable investment account, but make sure that you max out your retirement accounts before even messing with taxable investment accounts. Please do me a huge favor and Hulk smash that thumbs up button. Check out the description for more resources and playlists to help out with all of your personal finance and investing needs, as well as some ways to get some free stocks for yourself. I'll see you in the next one, friends. Done.